Hey everyone, it's Zach. It's October 14th, and we're going to talk about a few things today. First, the major indexes and the recent market follow-through day, the start of earnings season next week and how we can kind of handle it. We're going to definitely look over the Great Eight, so the heaviest names in the market, where they go, the rest of the market's likely to follow. And then we're going to wrap it up by reviewing our current watch list and some trade ideas that are actionable as early as Monday. So let's first get into the NASDAQ and revisit last week's follow-through day and see what the price action has done since then. But quick reminder, a follow-through day is when either the S&P 500 or NASDAQ move higher by 1.5% or more in any single trading day on volume heavier than the day prior. And a follow-through day essentially signals the start of a fresh market rally. So very simply put, if you see a follow-through day, you want to be primarily looking for long opportunities and be very cautious if entertaining the short side, because buyers are now in control. Now, before I get into that recent price data, I do want to quickly just take a look at these statistics here. So IBD data shows that, and IBD being short for Investors Business Daily, which is the company that created the follow-through day concept in the first place, it shows that if you get a distribution day 1 to 2 days after a follow-through day, those follow-through days have a 95% failure rate. If it's 3 days after the follow-through day, it's an 80% failure rate. And if you get one that's 4 to 5 days after the follow-through day, before getting your distribution day, the failure rate goes down to 30%. So let's kind of make sense of this real quick. So looking at the QQQ, we had our follow-through day on the 6th of this month. And the first distribution day was on the 12th. A distribution day means that the index or stock closes down on the day on volume heavier than the prior day. So the follow-through day was on the 6th. First distribution came on the 12th. 4 trading days after the follow-through day. So the odds that the low of our follow-through day holds and we see a powerful rally ensue in the coming weeks or months is about 70% from a statistical standpoint. Now you may ask, where is the study or how many data points were included, etc. That's fair. This is a study that I've had in my trading journal from years ago, recorded from a reputable source. But unfortunately, I can't provide anything more than that. I just thought it was an interesting and, quite frankly, encouraging statistic to share. So with that being said, the low of October 6th, our follow-through day low, 354.70 area, is very important and one that we want to watch very closely, because if we do break lower, it's likely we see fresh lows. Now, let's kind of talk about the most recent price action. So we broke above the 50 moving average early last week. However, we didn't clear it. And you may ask, how did we not clear it if price closed above it multiple days in a row? And that's because in order to label something a successful break or bounce, you need to close above the moving average by at least one ADR. An ADR meaning average daily range. So this is calculated by looking at the range of each candlestick from absolute lows to highs and dividing it by 20. So we'll take the last 20 candlesticks and divide whatever the ranges were for the last 20 days, and that's how we get our ADR. Now, you need for price to close above or below the moving average by one ADR in order for it to be considered a successful break or, in this case, a successful bounce off of the moving average. So basically, we closed above it here about 0.35%, which is not the 1.5 ADR, and then over here about 1.1%. So we never truly broke and cleared the 50-day moving average. Now, we did get rejected off of this downtrend line though. For now, the 5th time, which is quite rare. You get 1, 2, 3, 4, 5th time we get rejected there. Yeah, so it's not often that a trend line holds that long. And with each successive test that we do get on this trend line, it's not becoming stronger. In fact, the odds of it to continue to hold are substantially decreasing with each touch. And that's simply because the opposing force, the demand, the buyers, are showing increased aggression with each test. And the odds that that demand overwhelms the supply is only growing with each test. And therefore, the odds of it violating is increasing. Now, usually the fourth knock at that trend line is enough to, get the job done. If we look back here, 1, 2, 3 failed breakout, fourth was enough. Here, the downtrend line, 1, 2, 3, fourth did the trick. However, obviously that's not the case here. But should we test it again, the odds are increasingly favorable for bullish outcomes, and the reaction will likely be very powerful. I wouldn't be surprised to see us rip right up to the next, significant level to keep an eye on, which, by the way, if we break above 381, that's going to give us a double bottom breakout out of a major basing pattern, and would be the launch pad for the next leg up, with measured move being up around 411. Definitely a level to keep an eye on, this downtrend line. If we take a closer look at Friday's price action, we had a day where the bears maintained firm control. Volume was slightly above average. However, from a technical standpoint, not much really changed. We closed on the short-term moving averages and slightly below the 50 moving average. But remember, moving averages, trend lines, they're an area. You got to pretend you're drawing these with a crayon, not a pencil and a ruler. So, the Qs sit on a pretty strong support area as of right now. I also want to remind us that we have a gap support just below, right here. And we also have the previous resistance, now support. This all of which we cut through to the upside recently, and with conviction. You can see monster volume, very large bodied candlestick. So there's going to need to be a major break below this 362 level for this chart to really start favoring the downside, in my opinion. If we take a look at where we stand with regards to the cycle of price action, we had a wedge pop right over here, the first break above the 20 and the 10 exponential moving average. And now we're waiting for our first test and hopefully bounce off of the short-term moving averages, so the EMA crossback. We now have a short-term downtrend line to play if we wanted to get real aggressive to the long side. However, considering the wide-bodied bearish candlestick that we got on Friday, I think I will most likely play it safe and wait for confirmation of a bounce in the form of a higher high, which would be a break over this 10-12 long-legged doji that also coincides with the downtrend line. So that's going to give us a level of convergence as well. We're going to have to see how this chart builds out in the next week or so. Key levels to watch short term are the 362 support, the 374 resistance, which is our doji high, and also right around where the downtrend line sits, and also our follow through day low, which is about 354.7, because if we lose that, we're likely going to have another leg lower, perhaps come down and retest that 200-day moving average. Also, before we move on to the mega cap names, I want to briefly discuss all the bad news and the market's reaction to it recently, because how the market reacts to bad news is often the precursor to its future direction, and that's just standard Dow theory. So there's been plenty of bad news to this point, but as we mentioned, it's how that market reacts to that news that's important to us. We have a situation where there's been an ousted Speaker of the House, a lot of uncertainty there. On the leadership and the GOP side. Last Friday we had the jobs report. That headline was really strong, but under the surface maybe not so bad. And the market rallied and we saw a follow through day. 10-year bond yields were also spiking last week, creating fear and of higher interest rates. And of course we have the Israel and Hamas war that broke out, creating a lot of uncertainty. However, the market still managed to hold up, all things considered. And this is perceived as a positive, that the market is holding up amidst all the bad news, that pressure. To add on to that, this week we had, the recent PPI and CPI that came in hot, and the market was absorbing well up until about midday, when there was a bad bond auction signaling that there could be higher interest rates, which hurts small cap names more so specifically, which is why we had a huge sell-off on Thursday of last week in this index. But the market shrugging off some of this bad news is actually bullish for the market. We did have a follow-through day. So you really have to reset your mind. It's a shift. The chart's talking to us. And you have to be open to the fact that the market, even though it looked ugly a week ago, could be turning and giving us a nice rally. It's not about how you feel. We're simply interpreting the market's action, and we're taking actions or cues from the overall price action. Remember, as Dow theory states, the market is always looking forward, and it's discounting the future 6 to 9 months. Let's take a quick look at the weekly chart, just see where the indexes stand with regards to stage analysis. So the QQQ is currently in stage 2. It looks like it's trying to form a continuation base. We'll know we have successfully broken out of that base when we break above that 380 level, giving us that double bottom breakout. The S&P, let's take note of this recent candlestick, not very friendly. A lot of wick, almost looks like inverse hammer right off of the downtrend line. However, that can resolve fairly quickly. Being we have earnings season next week, the way that this chart looks can be completely different next week. You could have a nice bullish candlestick too. So earnings season is going to act as a major catalyst. S&P 500 is in early stage 3. We could see maybe another move to upside, test prior highs, or consolidate sideways for a couple weeks before breaking down to stage 4. That's if we break down to stage 4. We could very likely just be in a deep correction that eventually resolves itself to the upside. Only time will tell. IWM, the small caps, we are in stage 1. We never even broke out of this stage 1 base. And we look like we're potentially wanting to break down to stage 4 continuation. So we'll kind of have to see. Not really all that surprising that small caps have been struggling the way they are. We are in a higher interest rate environment, which is not friendly for them. Now let's take a quick look at the mega cap names. We'll start off with Amazon. You're going to notice that a lot of the big tech names were rejected off key resistance levels this past week. Not all that surprising to see that. Some even attempted to break out, but those breakouts quickly fizzled. And when you're short-term extended going into a major resistance level, it usually does not end well. And you're going to see a pretty quick rejection where the moving averages kind of fall back down to their short-term moving averages, the 10 and 20, to find their footing before giving it one more shot and seeing if they could actually make that breakout stick. So next week, or this upcoming week, we do have Netflix and Tesla both reporting. It's going to kind of shape the perception of how investors are going to perceive the upcoming big tech earnings. So if Tesla and Netflix both report well, if their earnings are received well, then you're going to see a lot of inflows into the other big tech names because investors are going to think they're going to report similar results. Now, if it's the opposite, you might have a lot of defensive selling in the other big tech names because they're now anticipating for the upcoming earnings for those names to be not favorable. So while on the topic of earnings season, I want to remind us that this is only going to be adding an additional layer of uncertainty to the markets, and we all know markets hate uncertainty. So there's going to be increased volatility. It's really just a time to reduce activity size until the indexes give a more concrete direction. If you're swinging any stock, be aware of which industry group it lies within, because stocks in the same industry group that are reporting are going to affect that entire group, and that's going to create a substantial gap risk. So for example, when Tesla reports on the 18th of this week, it's not going to just affect QQQ, the tech index alone, due to its sheer size, but it's also going to impact heavily the automobile stocks like Rivian, Lee, NIO, Lucid, etc. If AMD were to be reporting next week, it's going to be affecting the semiconductor stocks like MU, Marvel, Intel, and so on. So just something to be mindful of. Now, although earnings season is going to bring a lot of uncertainty, it also brings a lot of opportunity. And it's going to set the stage for the next quarter. So it's really a great time, and my favorite time, to create a watch list. And it makes it very easy to separate the strong names from the weak. I have a watch list for names that gap up, just like I have a watch list for names that gap down. Those that gap up are prime long candidates. Those that gap down, I'm looking for short opportunities. Really, that's going to be based around where the the market heads or where the market is. But why do earnings reactions create so much opportunity? A stock gapping up bigly, like we have here for Fast, is doing so because the earnings report changed the perception of value that investors have for that stock. And that earnings report introduced a large amount of information to investors that's now going to be priced in throughout the next couple of months, really up until the next earnings season or next earnings date. So that earnings report acts as a catalyst, which is what's needed to really generate powerful moves. So if we take a look here at PLTR, for example, and go back to its earnings report from in May, we have a massive gap up. Zoom in a bit here. Why? Because of the data dump from earnings. It caused for investors to perceive the value of that stock to be much higher. What's happening from a technical standpoint? We have, once again, that big gap up, powerful indicator of strength, especially if left unfilled as we have in this case. You also have monster volume, so showing conviction behind that move. You have a bullish candlestick that also shows us range expansion. So going back to ADR, what we learned earlier, if the stock's range for the day exceeds that of what the ADR is, so in our case 5%, then that's showing range expansion. So it was about 13% here. So Palantir was showing range expansion. And range expansion shows a momentum shift, and that's how major moves start. So a very strong technical chart supported with a powerful catalyst in the form of earnings is how major moves are birthed. Do you take action the day of the earnings gap up? You do not. You just wait to see how price reacts during its first consolidation. Is it a sideways consolidation that is really showing bulls have firm control and are not willing to give anything back? Or is it more of a shallow pullback as we saw here for Palantir, which is just a result of natural profit taking? Or is it a very deep pullback that's just signaling there's a lot of overhead looming above? When you create a watch list of gappers, you're going to have a large variety of stocks that you're going to be watching. And it's those names that flag sideways or have shallow pullbacks that are going to be your prime targets. If you really want to get into the nitty-gritty and get involved with the strongest of the strongest, you're going to want to get in the names that break out of their consolidation first. Those are showing relative strength. They're leading the market. That's where you're going to get the most powerful moves. This was what? This was like a 65% move in 3 days. That's like 500% on a 2-month contract. So that's how you really get involved with the best names, and that's why I love earnings season. It just helps me, separate strength from weakness, and it's where a lot of power can be caught in either direction. And just like we flag here to the upside, it would be the same thing to the downside. You get some kind of bear flag or sideways consolidation. Those would be the prime candidates for short opportunities. So now let's real quick, actually I want to look at gold. So gold just had a monster move on Friday. And this looks like it's the start of a major rally that's an ensue. If we just look back historically at something at similar setups, scenarios where we have almost twice the daily volume, it's about 1.6 times the daily volume with a monster bullish candlestick like this. Let's go back and see where was the last time we had that. So we had it right here, about the same volume, which led to a big rally in gold. We had it again right over here. If we just compare this volume to our rally from Friday, it led to a huge move. So I guess I can go back one more time. Let's see. I guess I don't see anything that's quite the same, but most recent precedents led to huge sustained moves to the upside. We're above the 50-day moving average. We're just below a downtrend line. Really, we need to get above this preferably the 2000 level. These are all psychological levels that are respected very, very much in gold. So preferably above the 2000 level, but I want to see how this flags in the coming days, and I want to get involved with some of the leading gold names, specifically AGI. This is one that's just held up remarkably, and you can see there was a lot of volume that came into it on the 13th. I'm not sure we're going to have enough time to catch and move with earnings on the 26th, but we might be able to. It's definitely something I want to be watching carefully in the coming days. That gold move The silver move can definitely see more upside. We're just going to have to kind of see how that pans out in the coming days, how that consolidation is that follows. Sideways, shallow pullback, what's going to go on there. I'm really just waiting to see that in the coming days. Now, let's take a look at the most recent RS leaders that we've been keeping an eye on. Where are they at? So we talked about it on Thursday that we were going to keep an eye on our RS leaders and see how they all reacted on the first pullback of the indexes, because that's how we can really condense this list and find the names that are truly the strongest. So ZS, all things considered, with the weakness we saw in the market, has held up very well. There's still quite a bit of air in between that 10 moving average and price itself, so this looks great. Crowd looks even better. There's still good amount of air between the moving average and price itself. It's barely given anything back at all. Palantir also looks great. Consolidating. We had a little bit of selling, but nothing to be concerned of. We're still well above that 10 moving average, and this is one that I see being actionable as early as Monday. I think I'm going to wait for a break above the this 18.5 level, but we'll have to see how price action is come Monday. SMPS, another one, holding up very well. Still a good bit amount of air in between the moving averages. Just giving it some time, the moving averages some time to catch up before hopefully breaking higher. AMD, on the other hand, not so hot. It had a pretty bearish candlestick here, engulfing the previous 3 days and closing back below that 50-day moving average, right on top of the short-term moving averages. Not that it's a bad looking chart, but it's just not, you can't compare it to any of these. So with that said, get it off the list. GPS, still looking good. Above those short-term moving averages, held up phenomenal. In fact, we have an inside day. Here, so there was clearly some that volatility contraction is what you generally see prior to another leg up. So I would love to see how this if this can break above Thursday's high on Monday or Tuesday. I might entertain. PanW, once again, cybersecurity names have just been doing stellar the last 2 weeks, really leading the market up. Still a good amount of air between the moving averages. Want these to consolidate for 3, 4, 5 days preferably. TTD, once again, just like AMD, big bearish candlestick, pick up in volume, get it off the list. Fast is the gapper. We're waiting to see how this consolidates in the coming days. You know the scenarios: sideways, shallow, deep. If it's deep, not really all that interested. If it's shallow or sideways, I will definitely be watching it very closely. So that's basically where we stand right now with the markets. We're just going to wait to see how earnings reactions cause the indexes to react next week. Kind of in this neutral territory right now. If we break below 362 on the Qs, it would be concerning. If we break below the follow-through day low, very concerning. Would definitely be looking short side for short opportunities in that instance. But looking at the seasonality, looking at the fear greed right now, which is down at 29, I'm definitely leaning to the bullish side. But we'll have to see how that pans out. No predictions here. Appreciate you guys watching the video. If you have any questions, as always, feel free to reach out.